Hello and welcome everyone. Today we are going to talk to Nitin and Shashank, again, very dear friends of mine, and we're going to talk to them about investing. So without further ado, let's get started. And my first question to both of you is, how and when did you start? So Nitin, if you want to go first, please.
I started right after I started work. So I started work at the end of 2007, right? And um, I think 2008 there was a recession, and I had very little work to do, right? So
Hmm.
I'm like, okay, then people were talking, and the stock market had crashed, and that became news. So when it became news, I got curious. And I had this friend Karthik who he started investing in stocks. His father always has been investing in stocks for like maybe now it must be like 30, 40 years, or God knows how long, but yeah, it should be a long time. And he said, why don't you start investing and stuff? I'm like, fine. And so there was this game called Money Buy, Money Control, which gives you virtual money. So you can play around with virtual money and see. So I did that for some time, and then I'm like, okay, so this it looks like, and I put little money. I invested peanuts, and so that's how I got started. So I just by putting little money in stocks because of the recession. So I obviously entered at a good time. I put very little money, and but then yeah, I wouldn't really call it investing because I invested, then I forgot about it for after some time, and I went back into it maybe 3 years ago or 4 years ago, which turned out to be a good decision because it looks like buy and forget worked out for me very well. But one particular small cap, which I have no idea about, but made me a lot of money, and I probably would have exited a long time ago if I had. But that was a fluke. I mean, I'm not saying that that's the right strategy. That was a complete fluke. But yeah, that's how I got started.
Interesting. Shashank, I don't know if you have some kind of a story.
So mine was slightly different. So the way I started off was basically I had a lot of my friends who used to invest in stocks and talk about it. And literally, I had no idea what was happening in stocks. And I felt massive FOMO. That is what got me invested. So I started off initially investing in ETFs in like 2014 to just get an idea what's happening. And then in 2015, I was like, yeah, ETFs are good, but rather let me start individual stocks. And that's how my foray into stocks and investing came about.
Interesting. Okay. So yeah, I think for me,
What about you?
Uh, yeah, so I think it's a bit of both. So I guess we always know that investing is the right thing, and we've learned compound interest and all of that, and how compound interest is probably the eighth wonder of the world, as some very smart people put it. So I guess I kind of knew what it was, but I just didn't have the right vehicle, or the right way to do it. And then I think once Robinhood started out, it just gave me the option where I could just put in $50 a week, which is at that time when I started is all that I could afford to invest. So I started doing that, and once I started doing that, I started to develop an interest, and I started researching. Okay, what are stocks? What are ETFs? What are mutual funds? What makes a mutual fund good, or what makes an ETF good, what makes a stock good, what is the reason I should buy or not buy, and stuff like that. So I started researching, but I think for me, the biggest trigger was when I got the opportunity to start investing, and I would not say trading, but investing much easier. So that's kind of what got me started, folks. So question again, maybe Shashank, for you is, have there been any specific learnings that you've had in the last X number of years from when you've started to today, in terms of investing? So any mistakes, what are your biggest learnings, anything specific like that?
That's a good question. Like, yeah, I think definitely I've had like a lot of learnings, right? Like, honestly, investing in stocks and investing in general is a learning experience. You will every day, I mean, not every day, maybe that's a stretch, but every ever so often, you will start learning about something new, and you'll start understanding of the fundamentals of economics, which basically drive a decision making. Like, one of my big learnings was around like what is ETF and understanding like why do you invest in ETFs and what are the decisions to invest in ETFs, or understanding when to invest in individual stocks. And when people talk about diversification, what does diversification mean? And how do you create the diversification? So there are multiple layers, but I would say if you want to get good at investing, my biggest learning would be I wish I'd started off earlier. Like, I've learned a lot in the past 5-6 years, and I'm like, if I'd started off at the age of 12, how much more?
12. Okay. Wow. Okay. 12. But did you have money to invest when you were 12? Like, you're talking about pocket money.
Like, exactly, right? Literally, like, if and when I have a kid, on his 12th birthday, I'm going to basically give the kid the money and go like, hey, listen, you need to take this money and invest it.
Interesting. Okay.
True. Yeah. So Nitin, I don't know if you have any. So that was very interesting, Shashank. That's very cool. So Nitin, if you have something specific that.
Yeah, actually, what Shashank said, I wish I'd started early. I kind of did. I mean, I don't think I would invest. I feel like investing when I wasn't working, but I started pretty early, right? Like I said, immediately after work, because it was the recession at the time. Sorry, I had some money. So it's just that I stopped investing, and I mean, then I went back into investing. I'm like, hey, my parents were telling me buy a house, invest in a house, and so I thought, okay, let me look at it. And the more I looked at it, at least in India, I mean, I know in the US the housing market is a lot more regulated, but in India it's very different. It's not regulated at all. And a lot of the maths didn't add up, and I'm not even doing like hardcore maths. I'm just doing mental mathematics, and it didn't add up. And also, red flags go up when I don't understand the maths behind it. If it's not simple, then maybe it's simple, but if it's not simple to me, then it's a red flag, and I tend to step back. So then I just held on to my money, and my money was in my savings account for like until probably I was 28 or 29, and so it's only after that I again started investing. And I investing is by putting them in fixed deposits, and then later moving into stocks. Maybe when I was 30, mutual funds again. But I still had my old stocks with me, which made me a lot of money. But I'm like, hey, I can't go through this headache again. I didn't want to think much, and so I was very lazy about it. And it's only after when I was so the biggest learning again was to define a goal early. So when you have a goal, then you feel like investing. So it could be to buy a house, or it could be financial independence, or whatever it is, right? You define that goal, or then I think, and it should be a long-term goal, at least when it comes to equity, I think. So if you define a long-term goal, then it's great, because then you'll feel like investing automatically. And it's the feeling of it. I mean, I didn't feel like investing when I was younger. I started late, and like Shashank, I think Shashank, in fact, I started even later than I did, right? Serious investing. And so it's because I didn't feel like investing. I didn't want to buy anything. I had the money, and like, fine, okay, if I want to buy a car, then it's not investment money. I just save up for a few months and buy a car or whatever, right? But it's not like that when it comes to investing for long term. You're looking at the long term. I didn't have that long term goal. That was, maybe I should have had that. It's more of a regret rather than learning. But yeah, it's one thing. But I have those goals now. But otherwise, in the market, I learned a lot about what stocks are, mutual funds are, and debt funds are. Debt funds are great. I'm glad I learned about debt funds. In fact, in my opinion, the biggest advantage of mutual funds are debt funds, because equity, you can, at least in India, you can easily reproduce the Nifty up to an extent, because there's a huge allocation to the top 5, top 10. But you can kind of try to simulate it, but when it comes to debt funds, it's very hard, and that's really the biggest advantage.
Interesting.
So that's another learning which I've had. Fixed income investments.
Interesting.
What about you, Agnel?
So for me, I think as both of you are speaking, so I wrote down a few points here, which I just quickly could think of, and I think for me, so a few things that I always talk about. So attitude greater than aptitude, right? So it's your attitude to investing and to the markets and to ups and downs that are way more important than how smart you are. Or, you might be the smartest data scientist or the smartest, I don't know, statistician and things like that. But I think if you have the right attitude to investing, you will definitely come out a winner. And I think both of you kind of spoke about the next point I had in mind is your time in the market is always greater than your timing the market, right? So don't try to time the market. Oh, you know what, it's going to dip now, so I'll buy now, and stuff like that and things like that. It's more important that you stay invested over a long period as against just trying to predict the future and stuff like that, especially the near-term future, which is very irrational, especially with us human beings. And another thing is, I think you also said start early. So definitely, I think that's something that I've learned. Diversify. We spoke about diversify. Another thing that's very important, at least in today's world, and I think Nitin, you spoke about the 2007, 2008, 2009, those few years, is stay invested, right? So think of this as a 40, 50, 60 year investment as against a 30-minute or a 30-day exercise for yourself. Avoid penny stocks. So, I mean, as much as possible, avoid penny stocks unless you think there's some real value in them. And then I think the last thing that I have, as I was writing down these points, is there's no get rich quick. So it's almost impossible, and it's going to be a very rare story where you buy a stock for like 30 cents and it's $300 in a year or something like that. There are stories like that, but it's going to be very rare. So it's rare, and don't believe the people who are very sure about such things. So I think those are my points on what are my biggest learnings over the last few years, guys. So yeah. So I don't know, any thoughts on that? If not, I want to ask you about your current.
Do you time the market though? Do you actually follow that advice?
I don't time the market. So that's what I do. So I try not to time the market. In fact, my strategy, Nitin, is that so I started off, like I said, with investing $50 a week, right? And today it's a little more than that. But I have my list of investments that I do every week, irrespective of whether that particular company or ETF is, in my opinion, extremely expensive, or in the world's opinion, extremely expensive or extremely cheap. Because which is why I'm not trying to time the market. It's not that.
So let's say you hypothetically you get this a lump sum, like a company bonus or a lump sum or some arrears or whatever, right? And now you have quite a bit of money. Okay. And now you're like, hey, I want to invest a significant part of it into equity. So and the day you get the money, the stock market went up by like 5 or 7 or 8%. Would you still buy the index fund or whatever on that day, or the ETF on that day?
Yeah.
Would you like say, hey, let me wait for tomorrow for it to go down? I'm talking about that kind of time.
Yes. So good question, Nitin. I think that's probably another thing that I've learned is in the short run, it may or may not work out. But if I have, and I'm making this number up, so let's say that I have $100,000 that I suddenly get as part of some, some bonus or, some lottery that I win or something like that. I would never invest $100,000 in one day. So that's something I would definitely not do. But what I would do instead is that I would invest it over 10 or 20 weeks or even 40 weeks, a certain amount of days or weeks. And I would invest, say, 5% over 20 weeks or 10% every other week over 20 weeks. But I would divide that money out over time so that I can average it out. Because I don't know that if it's gone up today by 7%, whether tomorrow it will go up by 10% or tomorrow it's going to go down by 20%. I don't know. Right. But what I know, so I don't know about the tomorrow. I don't know about the next week. I don't know about the next month, year. I don't know. But what I know, again, do I know for a fact? No. But what historically I have seen is that in the long run, so in the 5, 6, 10, 30, 40, 50-year period, it definitely goes up. So which is why I would divide that investment out over a 20-week period and, just make sure I stay invested like that, Nitin. So that's my thing. That at least that's what I would do with a large lump sum of money.